Good afternoon. Can you hear me okay? Okay, great. I'd like to welcome everybody to a very special discussion this afternoon with the president of the Minneapolis Fed, Neel Kashkari. It's been years since the Fed has had somebody in the Flathead Valley like Neel, and this is really a unique opportunity for all of us. But first of all, I'd like to thank Patrick Barkey and his staff for the BBR for partnering with the Federal Reserve to bring this to the Flathead Valley. So let's give a hand to Patrick. Also, just to recognize a couple of other people, there's two Helena directors here, Norman Nickerson and Bobby Wolstein. Also, Casey Lozar, who is the new VP and Director for the Center for Indian Country Development. So let's give them a hand as well. So my name is Larry Simkins. I'm the CEO and President of the Washington Companies in Missoula. More importantly, I've had the privilege of serving on boards of both the Helena Federal Reserve as well as the Minneapolis Federal Reserve. I was termed out in 2016. So I've had the ability to be around Neel for a short period of time as well as the Federal Reserve. In full disclosure, I was a Federal Reserve bank examiner for a while when I first got out of college. So I know kind of in the depths as well as at the different level. But one of the things that I witnessed during that time period is how important the engagement is with the communities and with the Fed. This is a very important time, and it's an important time for Neel to get feedback. He spent a couple days in the Flathead, and so these are not times where he's shaking hands and it's a visit. He's actually looking for feedback. And so as we go through this today, there's some mics around the room. We'll make sure that we give everybody the opportunity to have questions and answers. We'll take time to do that. When you do get the mic, please speak into the mic. This is being live streamed, and we want to make sure that we can hear the question. Don't be shy. Neel likes all kinds of questions, so we'll have the opportunity to ask him some questions here in a minute. If you've never heard of Neel and you've never met Neel, I'm sure you might have a picture in your mind of what a typical Fed president looks like and what their background looks like. That is not Neel. Neel started at the Federal Reserve in Minneapolis on January 1st of 2016. Amongst his other duties, he's on the Federal Open Market Committee. He was there on 2017, and he's there again this year in 2020. He's a voting member of the FOMC. Neel's background is interesting, to say the least. He's a rocket scientist by training. So he started out as an aerospace engineer, worked for a company in California that worked on technology for NASA. From there, he went to Goldman Sachs. He followed Henry Paulson, the CEO, to the U.S. Treasury during the financial crisis. And in 2008, Neel was confirmed as the Assistant Secretary to the Treasury, and he oversaw the Troubled Asset Relief Program, commonly known as TARP. He's got a deep knowledge of that, and I would encourage you to talk to him about that during the question and answers if you've got any questions. Following that, he returned to California. He worked for PIMCO for a while and decided to get into public service and actually ran for governor of California in 2014. His interest in public service led him to be interested in the president's job. And in 2016, he was appointed as the president of the Minneapolis Federal Reserve. During his tenure, Neel has had a very high profile, thanks in part to he's had a minority position in keeping interest rates low. He's also been outspoken on too big to fail, as well as educational and economic disparities and Indian country economic development and immigration. So I would highly recommend also one thing to take out of this. If you're not, I would be following Neel on Twitter. It's one place where I think you can get access to information on the Fed and the economy that you don't necessarily get all the time. You also get to see his commentary on his favorite team, the Cleveland Browns, and you might even get to see him ice fishing. So it's a little bit of everything. So with that, welcome to the Flathead, Neel, and I'll turn it over to him for opening remarks.
Thank you, Larry. Can you all hear me? Yep. Okay. Thank you all. Appreciate it. So let me just start by giving you a little bit of a background on why I'm here and why we're here. In 1913, the U.S. Congress created the Federal Reserve. This is our nation's central bank. But they did something unique. They wanted all the regions of our country to be directly involved in policymaking. So they created the Board of Governors in Washington, D.C. You may have heard of our chairman. His name is Jerome Powell. He was testifying before Congress today. Before, we call him Jay. Before Jay Powell was Janet Yellen or Ben Bernanke or Alan Greenspan. Those folks sit in Washington, D.C. But then Congress created 12 independent Federal Reserve banks and scattered them around the country, the ninth of which is the Minneapolis Fed. And our job is to represent this region. So Minnesota, North and South Dakota, Montana, part of Michigan, part of Wisconsin. And our jobs are to know what's happening here in our regional economy. And then I go back to Washington, D.C. every 6 weeks for what we call FOMC meetings, where we set interest rates for the country. And part of what I'm doing in those meetings is I'm speaking about what's happening here in our local economy or our regional economy. Now, we have to set interest rates for the whole country. And there's no, we all use the same dollar, so there's no separate interest rate for Montana or New York or California. We have to try to pick the interest rate that's optimal for the U.S. as a whole, but we want to make sure all of the regions are part of that process. So me coming out here today is really important because I get to hear from you, hopefully, about what's happening in the local economy, what are the challenges businesses are facing, what's happening to the labor force, what's happening to wages. All of these insights that you may share with me are going to make me smarter when I go back to Washington, D.C. So that's why I'm here. That's why I'm excited about having this conversation.
Okay, so we'll start the Q&A, and so there's mics around the room. While we're getting to our first question, you said Chairman Powell testified today. Tell us a little bit, what's the difference between monetary policy and fiscal policy? I think it's important to distinguish those two on what you do.
Yep, thank you. So fiscal policy is basically the U.S. government or the state government or the city government taxes us, right? They collect taxes, whether it's sales taxes or income taxes or business taxes, and then that money goes into the government coffers, and then elected officials decide what to spend on, whether it's education or defense or healthcare. That's the domain of elected politicians who are representing their voters and how much to tax and what to spend on. And each of us probably has our own preferences. Like maybe you would rather we spend more on healthcare to defense, or somebody else would rather we spend more on infrastructure. Those are each judgments that we have, and we express those judgments through our elected officials, and then they make those decisions. Monetary policy is separate. Monetary policy is simply how much cash, how much money we put in the economy to try to boost the economy or cool it down so that we can manage the ups and downs of the U.S. economy. So the segment is Congress handles fiscal policy, and they've delegated to the Fed monetary policy for us to handle. And we're charged with trying to make these decisions ignoring politics. So Congress has told us, we want you to achieve two goals. One is stable prices. Think of an economy that's not overheating, but also not limping along. And second, maximum employment. As many Americans as possible who want to work are able to find jobs. We try to manage those goals by moving interest rates up and down. So if we think the U.S. economy is grinding to a halt, typically the Fed will cut interest rates to make it cheaper for you to get a mortgage or to get a car loan, to encourage you to go out and spend money to boost the economy. Or if we think the U.S. economy is overheating, we will typically raise rates to make it more expensive for you to buy a car or buy a house, and that's a way to tap the brakes on the economy. So monetary policy is managing these ups and downs of the U.S. economy. Fiscal policy is separate. That's taxing and spending based on the priorities that the people have.
Often referred to as the dual mandate, right?
The dual mandate is what we have, which is stable prices and maximum employment.
And we'll get into employment a little bit, hopefully a little bit later. But first, let's get a question.
So actually, I want to follow up on that conversation on your dual mandate and employment.
Could you tell us who you are, please?
My name is Chani Okert, and I'm a nonprofit consultant.
Thank you.
And when you were here in 2016 in Whitefish, you had given us 3 options moving forward in talking about employment. One is to increase child care tax credits. The other is to face stagnation like Japan. And then the third was to increase immigration. What is your stance now?
Well, you've got a great memory. In fact, you remember that from 3 years ago, so well done. So let me just give some context for everybody. One of the big sources of economic growth is simply population growth, right? If we're having more kids, then we have more workers to produce things, and we have more consumers to buy things. But the US and across the whole country, our birth rates are going down. This is happening all around the world. As societies get wealthier, people tend to have fewer kids. But that means if we're going to have fewer kids going forward, then we're going to have fewer workers to produce things and fewer consumers to buy things. And all else being equal, we will have slower economic growth. So I always say to people, that's the math that the lady was kind enough to remember. The math is very simple. You've got three options. Number one, you can accept slower growth. Number two, you can try to subsidize fertility, which is tax credits for families to have more babies and more child care. Let me just point out it takes 18 years to grow a new worker, so it's not a very fast program. Japan is trying that approach with very limited success. Or three, you can embrace immigration so that we have more workers and more consumers. And immigration has been a big driver of economic growth in America over our history. Now, this is a political question. Each of us will have our own preferences. If it were up to me, I think immigration is a big competitive weapon, a positive competitive weapon for America because people want to come here. So in my view, we should design an immigration system that meets the needs of our economy and puts us in a position to grow and compete going forward. That would be my preference. I don't like the idea of slow growth. And I also think the idea that we're going to subsidize fertility to encourage families to have more babies, that's going to be darn expensive, and it's unclear if it even works. But those are the three choices that we have, and that's just math.
So before we go to another question, just to continue on that, and I think the Fed right now has pivoted to the point where they've acknowledged slack in the labor market. You have been on that for 4 years now. And so talk a little bit about slack in the labor market and your thoughts and how that impacts your stance on interest rates.
So historically, the national unemployment rate today is about 3.6%. Historically, that would be considered a very low unemployment rate. In the peak of the Great Recession, the unemployment rate was 10%, so it's fallen quite a ways from there. Well, usually when unemployment falls and businesses have to compete to find workers, you see wages pick up, and eventually that leads to inflation. Well, as the unemployment rate fell from 10% to 3.6%, wages only picked up a little bit. They picked up modestly, so it's been a big question mark. What's going on? Why haven't wages picked up more? And I think the answer is there are many more people who've been looking for work that are not counted by that unemployment rate. So that official unemployment rate, 3.6%, it only counts people who are actively looking for work. If you gave up looking, because let's say your factory got shut down and you just couldn't get a job for 5 years and you just said, you know what, I'm done, I'm not looking for work, you're not counted as being unemployed, even if a job were to come along and you might take it. So we've been pleasantly surprised over the past 4 years how many Americans came off the sidelines. We didn't know how many were out there and took jobs, and that's what's enabled the economy to continue to grow and not have wages really taking off yet. Wages are picking up, but they're not accelerating at a rate that we would have expected to see given where the unemployment rate is. So to your question, Larry, we still don't know how many more workers are out there that in fact would like to work if there are good jobs available. I hope there are more, and I hope they can find those jobs because they will help us grow the economy.
Great.
Other questions?
Hi, I'm Jim Stroud. I'm a financial advisor and portfolio manager with UBS in Hudson, Ohio, by the way.
You're kidding. What are you doing out here?
In fact, I live right across the street from where you went to high school. I ski out here.
Good for you.
My question is regarding the yield curve. And we had a flat one for a week or two this summer. And I was wondering your opinions on a flat yield curve and recession in the light of negative interest rates around the world.
Well, so I grew up in a little town called Stowe, Ohio, right next to that gentleman's town of Hudson, Ohio, and I went to high school in his town, so it's a small world. So let's talk about the yield curve. What is the yield curve? You may hear about it in the press. The U.S. government borrows money from all of us in the form of treasury bills and treasury bonds. So if you buy a one-year bond from the U.S. government, you're loaning them money for a year, and you're getting some interest rate for that. If you buy a 10-year bond, you are loaning the U.S. government money for 10 years, and you're getting an interest rate for that. Now, typically, if you're going to tie up your money for 10 years, you're going to want a higher interest rate than if you tie up your money for 1 year. So if you plot a graph of all of these interest rates that the U.S. government borrows, it generally creates a curve that slopes up, and that's called the yield curve, and it slopes up. Well, once in a while, something goofy happens, and instead of sloping up, it flattens or it even slopes down, where you loan your money to the government for 10 years, and you ask for a lower yield than if you were tying your money up for 1 year. It's kind of a weird thing. Well, this inverted yield curve that the gentleman asked about, this is the best predictor we have of a future recession. So why would this signal a recession? Basically, why would you lock up your money for 10 years at a low interest rate? You would do that if you were nervous about the future. If you didn't know if a recession was coming, you didn't know what downside risks were there, you're basically saying, I will lock up my money for 10 years, and I just want to make sure I get it back, even if I don't get a very high return. And so this, whether it's correlation or causation, is a little bit unclear, but an inverted yield curve historically has been the best predictor we have of a recession in the next year or two. And as the gentleman said, over the summer, the yield curve had inverted. Well, around that time, the Federal Reserve, my colleagues at the Fed, decided to start cutting interest rates because we saw some downside risks in the U.S. economy. And we have some influence on the yield curve. When we move our interest rates up, we control the front end of that curve, short-term rates. And by cutting interest rates, we then uninverted the yield curve, and I think reduced the risk of, at least reducing the risk of us creating a recession on our own. So this is a very complicated topic that partly relates to global growth expectations, partly relates to the stance of monetary policy. At a minimum, I think the yield curve can tell us if we have over-tightened monetary policy, and I'm glad that we cut interest rates so that we undid some of that inversion that I think that we had caused. We could talk a lot more about this, but we'll take up the whole time.
Yeah. Okay.
Thanks for coming to our community. My name is Dennis Beams. I'm a local banker. My question involves too big to fail or too small to survive. The number of banks is being reduced through mergers and acquisitions. De novo startups are very rare now. Did Dodd-Frank help the too big to fail goal?
Well, so Dodd-Frank is a legislation that Congress passed after the financial crisis to try to make the big banks safer. I think Dodd-Frank did some good. I do think the biggest banks today are safer than they were 10 or 12 years ago. In my judgment, and in our judgment, the Minneapolis Fed, they're not yet safe enough. They're still too big to fail. They have more capital. They've got longer-term liquidity. Dodd-Frank did some good. But perversely, it also made some of the benefits of being bigger, because it did impose a lot of compliance costs on small banks, and it's much harder for small banks to absorb those costs than it is for the giant banks. So I think in some ways it made the competitive disadvantage for small banks worse, and at the same time it did not go far enough in actually addressing the too big to fail problem. The best solution we have, in my judgment, is to substantially increase the capital requirements of the biggest banks. Most small banks in America today have much higher levels of capital than the giant banks. But small banks are not risky for the economy. So it's the exact opposite of the way that it should be. So we think that big banks need to have much higher levels of capital, and that'll help level the playing field somewhat between the large banks and the small banks.
Okay.
Hi, my name is Kate McMahon. I'm a land use planning consultant here in Whitefish. And there's actually two issues that have come up recently with communities that I've worked with that I'd like you to address. One of them was a child care feasibility study that I did along the High Line in Montana. And the Federal Reserve Bank in Minneapolis has done some work on child care and early childhood education that I think would be of interest to this audience, and was wondering if you could just describe that. The other issue is climate change. That's come up with communities that I've been working with, and I understand that the Federal Reserve Bank in San Francisco recently this fall did a conference on that, and I was wondering if that's something that the Minneapolis region will be looking at as well.
So first on childcare, specifically the Minneapolis Fed for the last 20 years has done a lot of research on the economic return and benefits of investment in early childhood education. So getting kids started very early, especially for low-income kids. I mean, basically the research shows for middle class and well-to-do families, the children generally get a lot of exposure to reading and to different forms of mental stimulation that prepares them. You know, the research has showed that it's the first 1,000 days of life are the most important in terms of learning because the fundamental wiring of your brain takes place. So young, infants and young babies need to have a lot of that intellectual stimulation very early on. And our research has shown that somebody asked us, if you were to spend $1 of government money, where can you get the highest return for taxpayers? The research has shown $1 of government money invested in high-quality early childhood education programs, especially for low-income families, has the best return to society of anything that we could find. And the reason it's kind of obvious, if you invest in young kids who don't get the stimulation on their own, then they are better prepared to succeed in K through 12, better prepared to succeed in the workforce, and then there are all the societal benefits that come of that. And so that's been the focus of our research at the Minneapolis Fed. On climate change, you're right, the San Francisco Fed did a conference on this. I think various Federal Reserve banks are looking at, what's the role of the Fed in this. We have studied, there was a flood in North Dakota, I think it was Grand Forks, 20 plus years ago, and the Minneapolis Fed did a bunch of research after the flood happened to analyze the economic impact of that event and what did it mean for the local economy. So one angle of looking at climate change is how do we make sure that, for example, banks that we supervise have enough capital to withstand the potential exposures if there are different weather events. So let's say if hurricanes are more common in global warming and a hurricane hits part of the country, how do we make sure that the banks are resilient enough to be able to keep lending through that environment? So weather events and hurricanes is one angle. I think the tougher angle for me to figure out, when we set interest rates, we look at a horizon of the next 3 to 5 years. It's not clear to me that the climate is changing so rapidly that it's affecting how we should be setting interest rates, given that monetary policy just works over the next 3 to 5 years. So I think there are longer term issues that we're trying to understand. The direct connection to monetary policy, it's at least less clear for me, but I'm keeping an open mind.
I think it'd be interesting for us to hear a little bit more about the recent efforts you've had with Children First. Is that what it's called in Minnesota with Alan Page? And yeah.
So in Minnesota, one of the surprises for me moving to Minnesota was that Minnesota has some of the worst education achievement gaps in the country. So the difference between low-income Minnesotans across the state of all races and middle-class and well-to-do Minnesota kids are huge in terms of their achievement, graduating high school, college preparedness, et cetera. And we have huge racial disparities, some of the worst in the nation. It really surprised me. And as we investigated why do these exist, there have been many attempts in Minnesota over the last 20 or 30 years to close these gaps. Nothing has moved the needle. If anything, they're getting worse. So there's a legend in Minnesota, a legendary person, Alan Page, who was a Minnesota Viking legend, Hall of Fame NFL player, who went on to become a Minnesota Supreme Court Justice and spent 22 years on Minnesota Supreme Court. While he was playing Hall of Fame quality football in the season, in the off season he was going to law school, a kind of a remarkable man, and then committed himself to a life in the law. And 30 plus years ago formed an education foundation with his wife to help low-income kids get access to college. So education's been his passion. So I reached out to him about a year ago and said, is there some way we could work together to try to change this so that we don't have these gaps, so that 20 years from now we're not looking at the same problem that we've been looking at for the past 20 years. And he and I have come up with a proposal to change Minnesota's state constitution so that all children in Minnesota would have a civil right to a high-quality public education. We think that this could be a giant catalyst for breaking through the political logjams that have prevented reforms from taking place. We announced it, and it's very interesting. We have Republicans and Democrats supporting us, and we have other Republicans and Democrats against us. And the ones who are against us, in my judgment, are the ones who have the most to lose, which is their power. If you put power in the hands of families, somebody's giving up power. And we think we should be putting power in the hands of families to make sure that children get a good education. But we'll see. There's a lot of interest in the state. I would argue in Minnesota, this is the #1 public policy issue facing the state, and they've been making no progress. So, the old adage, repeating the same behavior and expecting a different outcome is insanity. So we're trying to challenge that. Now, I don't know off the top of my head. We surveyed the 50 state constitutions. I don't know off the top of my head what the Montana state constitution says about education, but many states have updated their constitutions around education. Minnesota is an outlier in having not done so since 1857.
So I think it's interesting with Neel, when you think about what his daily life consists of with monetary policy, all the different things that he's reading and looking at, to be as passionate as he is about early childhood education and education in general. He was the catalyst for a meeting that we had in Billings 6 months ago on early childhood education with business leaders around the state. It was a productive meeting, but it's one of those topics that it's hard to take the next step. And I think we all really appreciate the help and the lens that the Fed is putting on this, because it's something that needs to be resolved, and state by state it needs to be resolved. And we're trying in Montana. Lots of private foundations are meeting on this, lots of educators, government, business people. It's just a matter of, we're so big, it's hard to get it together. I don't know if you've got any perspective on early childhood in Montana versus Minnesota, or your thoughts on that.
Well, one thing we heard, we had actually a meeting this morning on this topic. One of the challenges that we heard about in Montana is that people are so spread out that it is hard to get the economies of scale of center-based care just because people have to commute long distances. So that's another challenge that folks have. But we do know that if my wife and I have a 1-year-old baby girl, and fortunately we have the resources that we can get very high quality care. But if you can't afford it, it directly affects families' ability to have both parents participating in the formal workforce. So there are economic implications of this, but quality is of paramount importance. So there's no easy answer, unfortunately, but it's something we all have to keep working on.
Another question?
My name is Orrin Weber, and I'm a financial advisor here in the Valley. And I believe it was today I heard that Jerome Powell said that our $1 trillion debt is unsustainable. And I'm just wondering if you can touch on what the Federal Reserve talks about as what unsustainable means, what it might look like. And then secondly, that the tax cut of 2018 added considerably to that debt. What effects there are to address that going forward, being as you don't set those rules, Congress does?
Well, so right now the U.S. government debt is bigger than it's ever been. Not necessarily as a share of GDP, but it's getting close. But the U.S. government is borrowing at very low interest rates. So the 10-year Treasury, I don't know, I didn't look this morning, is around 1.6%. It's a very low interest rate relative to our history. That means that even though there's a lot of debt outstanding, people still have a lot of confidence in the U.S. economy and the U.S. government, and are willing to lend money at very low interest rates to the U.S. government. So right now, there's no immediate debt or deficit problem just by virtue of the fact that the U.S. government's borrowing money at low rates. But the question is, when do these increasing deficits become a problem? And nobody knows for sure, right? Right now, it's a little bit of a relative game. So relative to Europe, the U.S. economy looks fantastic. And so people say, yeah, I'd like to invest in America. Relative to China, especially with coronavirus and whatnot, the U.S. economy and the U.S. political system, as dysfunctional as the Iowa caucuses seem, our political system works pretty well relative to many other countries' political systems. So people still vote with their checkbooks and say, we have confidence in America. Now the question is, when is that going to change? If the deficit keeps increasing forever, eventually investors might say, you know what, I'd rather invest in Europe, or I'd rather invest in China. And then if there is another major economy that people have more confidence in, then you would imagine our interest rates would go up, and it would be more and more difficult for the U.S. government to continue to fund itself. And so I think the chairman is right that if you just look at current law with entitlement programs like Medicare and Medicaid and Social Security, if you just look at the law, the deficit is forecast to just take off over the next 30 years. That can't happen. Something has got to change. And that ultimately is going to be a political question. Now, why do those programs why do they all take off? Back to what I said about population growth. those programs are generally funded by current workers paying for current retirees. Well, as our society ages and we have fewer and fewer future workers to pay for today's workers, those ratios go imbalanced, and then the deficit takes off. So one of the answers could be, if we don't want to change those programs, one of the answers could be open up immigration a lot more so we have many, many more workers that are paying taxes, paying into those programs to fund those programs. But these are all political questions about, do you want to cut benefits? Do you want to increase immigration? Do you want to raise taxes? The people have to decide through their elected representatives.
So rising debt, low interest rates, stock market at all-time highs. I've had the question quite a few times, I'm sure you do almost every day. How do you know when we're in a bubble? I mean, if you're, and being in a bubble from the standpoint, if I'm a local businessman and I own a couple of rental properties and the value of my real estate is going up every day, and I don't want to be in the same situation I was in 2008, I mean, what should I be looking at, and how should I be viewing that?
Well, it's very difficult to know in advance. This is being live streamed. A lot of angry people on Twitter are going to criticize me for saying this. It's very difficult to know in advance when you are in fact in a bubble. And if you knew for sure you were in a bubble, then you would take measure to try to prevent the bubble from continuing to grow. And I'll give you an example. In 1996, Alan Greenspan, who was then the chairman of the Federal Reserve, declared very famously that there was irrational exuberance in the stock market. That was 96. The stock market then climbed for another 4 years to 2000 before the bubble finally burst. But was it really a bubble in 96? Or was the bubble in 99? I don't know. And then when it comes to the Fed, what could the Fed do about it? The one tool we have, well, one of the tools we have, the primary tool we have, are interest rates. So the question is, in 1996, if Alan Greenspan believed we were in a bubble in the stock market, should he have raised interest rates to prevent the stock market from climbing any higher? I think the answer is clearly no, because the cost to the economy of raising rates from 96 to 2000 would have been much higher than the actual minor recession that followed when the stock market bubble burst. So in that case, the medicine might have been much more costly than the disease itself. So that's one example. Another example is the housing bubble. When the housing bubble burst in 2008, that was devastating for the US economy. So what's the difference between the stock market and the housing bubble? One of the differences is debt. There's much more debt backing the housing market than backing the stock market. So you go buy a house, maybe you put 20% down, maybe you put 10% down. That means it's mostly debt supporting that asset class. So if somebody is worried about a bubble today, I would just say, don't saddle up debt. If you've got some rental properties, my humble advice is, don't take out a mortgage against those rental properties just because the price seems to be going up. If it's all equity and you don't have any debt on it and the price comes down, you're going to be fine. If you take out a big mortgage underneath it and the price comes down, you're going to be in a lot of trouble.
Yeah. Okay.
My name is Jim Kenyon, Whitefish Credit Union. I guess first off, I'm going to respectfully disagree with your last comment there, as we are a big lender in the Valley, so we like people taking out mortgages.
Who are you going to trust?
In all sincerity, we really do appreciate the time you spend in Montana and certainly up here in the Flathead Valley.
Thank you.
My question is around money velocity. As you know, it's at an all-time low right now. I guess I'd like your thoughts on how you feel about that, whether you think it's going to go lower or what is going to need to change to turn it around, I guess.
Well, I spend with my researchers a lot less time looking at money velocity and thinking about that than they did historically in, say, 20 or 30 years ago, trying to assess the stance of monetary policy. Spend a lot more time now looking at inflation and inflation expectations and where interest rates are. There's a very key concept for us as we set interest rates. That is, what interest rate is neutral for the economy? What interest rate neither stimulates the economy nor holds the economy back? Well, we believe over the last 30 or 40 years, that neutral rate has slowly been declining. Now, we don't set the neutral rate. That's something that the economy gives to us, and we try to set interest rates based on where we think neutral is. And what determines that? Productivity determines that. Birth rate determines that. Demographics determine that. Savings determine that. If people are saving a lot, then that'll have a lower neutral rate. So it's a long-winded answer to say I focus less on the velocity of money than I am on where do I think the neutral rate is and where are interest rates relative to neutral. My best assessment today is that interest rates are slightly accommodative. We could be around neutral to slightly accommodative. I don't think we're providing much boost to the economy. Even though interest rates look like they're quite low relative to history, they're not quite low relative to neutral. And that ends up being the more important factor as we think about where the economy is going from here. And that's sort of the gentleman's question earlier about the yield curve. You know, when we move interest rates up and down, we're moving an overnight rate up and down. That moves the front end of the yield curve up and down. The back end of the yield curve is more set by fundamental macroeconomic factors. So as we raise short-term rates, we basically flatten the yield curve. And I think the yield curve is giving us feedback on where neutral is. And that's why I think we're close to neutral or slightly accommodative today, but not very accommodative.
Hi, I'm Connie Behe. I'm the director of the Flathead County Library System. We changed our name to Imaginative Libraries in 2014. I'd just like to take a step back to the early childhood development comments that you had. We're a recognized leader here in the Flathead Valley for early childhood education and provide free access to all ages. I would like to know how public libraries have entered into a conversation about free and equitable access to high-quality childhood education.
Well, I'll confess to you, until your comment right now, it had not come up to me. In the meetings that I've had about early ed, there have been folks talking about the role of the K-12 system in going earlier. There have been independent centers and the work that they do. I'd also heard of businesses saying we're going to set up our own center because our employees need access. I had not heard of public libraries playing a role, but it's now that you mention it, it seems obvious that they would have a role to play, and it would be a logical place.
I'm going to send you information about our programs.
Okay, send it to Rhonda. She's
And
right
you
next
can
to you.
call, I'll meet with you anytime. So.
Good, thank you. Appreciate it.
Okay, over here.
I am Chris Pease with Idaho Forest Group, plant superintendent. My question is, after the recession, we went from a balance sheet of $870 billion to roughly $4.5 trillion, and I think we're hovering around the $4 trillion mark. A lot of that is mortgage-backed securities, and I guess that was kind of a paradigm shift in how the Fed managed their balance sheet. So I guess my question for you is twofold. What are your thoughts on that volume of mortgage-backed securities in the balance sheet? And then how does that affect the Fed's ability to respond should we have another recession similar to 2008? Do we have the capacity to absorb even more into that balance sheet?
So there's a lot underneath the question you just asked. So the Fed's balance sheet is set by a number of factors. One of the factors is simply the demand for U.S. physical currency all around the world. And people demand U.S. physical currency at much faster rates than the U.S. economy is growing because they trust it. Many other currencies they don't trust, people do trust the dollar. So there's always demand for dollars. So part of the reason the Fed's balance sheet has grown over the past 12 years is simply to keep up with the demand for U.S. currency all around the world. There's nothing nefarious about that, nothing spooky about that. That's just literally people want dollars and they're willing to pay for dollars, and the U.S. economy is benefiting from that. So that's part of it. Another part of it is there have been new regulations imposed on big banks so that they have more short-term liquidity, or they're able to fund themselves and not have to turn to the markets if they have some kind of a hiccup. That also has increased the demand for what we call bank reserves, which also then increases the size of our balance sheet at the same time. That also is not a bad thing. We do think it's good that banks have better liquidity and can meet their own liquidity needs. That's another reason. The third factor that got a lot of attention is something called quantitative easing, where we expanded our balance sheet by buying long-term bonds, treasury bonds, and mortgage-backed securities, as you said. So let me back up and explain why we did that. I said that we moved short-term interest rates up and down to manage the ups and downs of the U.S. economy. Well, why do you care about short-term interest rates? If you buy a house, you care about the interest rate over the next 10 years or the next 30 years, not an overnight interest rate. Well, by moving short-term interest rates up and down, we actually do have some effect on long-term interest rates, and that's where the stimulus is provided to the U.S. economy. Well, once the Fed lowered interest rates to zero, the question was, are we out of ammunition? And the answer was no, because then the Fed started buying up long-term bonds to drive down those long-term interest rates directly. Well, then, so that went on. That provided some stimulus to the economy. Then a few years ago, we started shrinking our balance sheet back down. And we shrunk it back down until about September of last year. And then we realized that maybe we're at the limit of how small we can get it, given that there's still this big demand for dollars out there, and given that many banks still have demand for reserves so they can meet their own funding needs. So that's a long answer to your question. To the second part of your question, yes, we do have capacity. If there were another downturn, what would likely happen is we'd likely cut short-term interest rates to zero, and then if needed, we would likely turn to quantitative easing and expand our balance sheet further to try to drive down long-term interest rates. So no, I don't think we're out of capacity. I think that's a tool that we would have more confidence using because we've already done it once before.
Let's divert before the next question,
Sure.
just because I think it's important to hit this as long as you're here. Montana, with the history of the ag economy, recently with lower commodity prices, trade wars, tariffs, all the different things that are going on. Help us understand kind of your stance on the ag economy and where it's at now, and your thoughts on ag in general.
Yeah, ag has been under pressure, as you all know, for years now. Before the trade war and the tariffs, it was a lot of production. And if you're very productive and you have got high output, you end up in a commodity market with lower prices. So that's been going on for a number of years. And then you layer on top of that tariffs and trade war, and it becomes very costly and very painful for many farmers. And you are seeing consolidation in the ag sector. You are seeing some bankruptcies in the ag sector. The more financially stretched farmers are saying, I just can't make ends meet anymore, and they're selling out or they're going through bankruptcy. So, and unfortunately, I don't see anything on the foreseeable future that's really going to change that, because even though they've been under a lot of pressure, and even though there have been weather events, depending on the commodity, farmers keep having very productive years. And very productive year after very productive year leads to continued low prices. And so I think that's going to be with us for a while. The one thing that we pay a lot of attention to is what's happening to ag land prices. And basically, in most of our region, land prices have not fallen very much at all. So that's important because the land is collateral for the banks that are making loans to farmers. So one of the bad scenarios would be if ag land prices all fell, and now you have all these loans that are going bad, and you've got these banks that have made these loans that now their collateral is not worth what they thought it was, then there can be a ripple effect, and it can spiral and be very damaging to the ag economy. We're not seeing that. So somebody is stepping in and buying up the land and maintaining the prices. How much longer can this continue? I don't know, but it seems like it's the new normal that we're in, at least for the foreseeable future. The good news is it seems like the battles with China are not getting worse, the tariffs, whatnot. And now that USMCA has been signed, Canada and Mexico are very important trading partners. So that's reducing some uncertainty, so that should help on the margin.
Great, thank you.
Thanks. Hi, I'm Tino Sonora. I'm with the BBER. I just have a quick question on, quick to ask, hard to answer, about healthcare and what you think the impacts of rising share of our GDP being pushed onto healthcare and what long-term macro effects that will have. And then sort of part of that is, as a larger percentage of people's per capita income is being basically diverted towards healthcare, what long-term impacts that might have.
It's unclear. I look at this, and I might be wrong, I look at this as though people value healthcare. And people are saying, I want to spend more. Like if you think about all the things you value in life, your health, the health of your family, or take a separate category, leisure, vacations, etc. I think what we're seeing is, as a society, we are saying, hey, healthcare and the health of ourselves and our families are really, really important to us. And that's going to crowd out some spending on other things. Now, If it ends up crowding out spending on education so that we're not able to invest in the future, that's a debate we're going to have. If it's crowding out spending on defense, that's a debate that we're going to have. And so I don't know, I can't tell you what it necessarily means for economic competitiveness. I mean, if we could have the same health outcomes and spend half as much, that'd be great, because then we could spend those resources on other things that are also important to us. But I think one thing we're just seeing right now is, it's understandable, we all value our health, and so we're spending money on the things that we value. I don't know, I don't have a better answer for you than that right now, unfortunately.
Hi, my name is Mark Roston. I advise large financial institutions on their investing. Could you comment on, in the context of too big to fail, either your personal views or the Fed's views on narrow banking?
Yeah, so narrow banking, it's a complicated concept. Basically, it's a bank that you can deposit your money there, they will turn around and deposit at the Fed, and then they'll earn some spread, and then they'll give you a return. But they don't make any loans. So, there's a mathematical concept that I learned in, calculus or differential equations way back when, called the trivial solution. I think narrow banking is basically the trivial solution, which is, it's an economic concept that makes sense, that's not really taking any risk, but is also providing very little service to the economy. So what's the point of that? I don't know. I mean, to everybody else, I'm boring you with that answer, but he asked a very specific question. Go ahead.
Yeah.
Well, he's got to follow up.
Yeah, so in the context of narrow banking, if with technology today, we can separate transaction processing from store of value. And so if the problem it solves is pure transaction processing, I guess I understand your notion that it's a trivial solution because a bank won't lend. But if there's no need to get your money out of your vaults to make it safe, or you don't need to make money because your bank doesn't have to be profitable. So for example, look at Flathead Valley. If Walmart were allowed to provide narrow banking services because there's no lending going on, then you could bank a whole lot of people in the Flathead Valley who might not otherwise have banking, or other contexts where people don't have banking. I guess I'm just curious, given that it can separate, why you view it as a trivial solution.
It just isn't obvious to me. I'm going to give a glib comparison. I can build you a car that is 100% safe, and it goes 0 miles an hour. Okay, it isn't obvious to me what problem you are solving by this. Anyway, we could have another discussion or offline another discussion. I hear people make all sorts of very interesting proposals, and this is not your proposal. There are many narrow bank proposals out there. But the moment I sit down with our economists to really try to understand what problem is it solving and what is it accomplishing, it isn't obvious to me. But we can follow up.
Since we're there, your daughter's a year old. If I want to buy her a gift, would you prefer I give her a low-yielding treasury bond or a Bitcoin? Between those two, I'd take the low-yielding treasury bond. The Bitcoin and cryptocurrency, it's like a giant garbage dumpster. The reason that the dollar has value is because the U.S. government has a legal monopoly on producing the dollar. If you go in your basement and start photocopying your dollar bills, the Secret Service will come and knock on your door and arrest you. Only the U.S. government has the authority to produce dollars. That scarcity is in part what makes them valuable. Well, the virtual currency, cryptocurrency world, there are thousands of these garbage coins out there. Thousands of them, literally. People have been fleeced for tens of billions of dollars. And finally, the SEC is getting involved in cracking down on this. But people are just getting fleeced by nonsense. And so I can create Neel coin, you can create Larry coin, I can create something that looks just like Bitcoin, and you won't be able to tell them apart. It's just a giant garbage dumpster at this point. And maybe 5 years from now, or 10 years from now, or 20 years from now, something useful will emerge from this. But so far, all that's
emerging is burning garbage. So no, don't give my daughter Bitcoin.
Thanks. It's Joe again from First Interstate Bank. I would argue most business owners in here have cause to wake up at 3 a.m., bolt upright, worried about something, maybe workforce. To the extent it's not related to your 1-year-old daughter, and you wake up at 3 a.m. worried, what are you worried about?
You know, we always worry about the things we're not focused on right now. So I've been very focused on for the last 4 years, as Larry said, to try to understand, are we really at full employment? Are there more workers out there? What's happening to wages? We have folks at the Federal Reserve System that are very focused on financial stability and looking at risks in the financial sector. Generally, the risks emerge the place you're not looking. And so, you know, the thing that I guess would keep me up at night or anyone up at night is, what are all the things I'm not thinking about that I should be thinking about? If it's the thing that I'm actually thinking about, that's probably not where the problem is going to emerge. And so it's not a very satisfying answer, but it's probably true. You know, when I first went to Treasury in 2006, so I was appointed by President Bush before the financial crisis, and the Treasury Secretary, Henry Paulson, had charged me and a few others, working with the Fed and the SEC, to look for where a crisis could come from. Because Secretary Paulson said, we're due for something. The economy's been too stable for 10 years. We're due for some shock. So we looked all around. We didn't consider the scenario of a national home prices falling all across the country. We looked at half a dozen scenarios. Unfortunately, that wasn't one of them that we looked at, and that's where it came from.
Yeah, I'm Dan Sullivan. I'm a retired contractor from the North Central Montana. And I'd like to thank Bobby Wolstein for inviting us to the seminar. It's been very interesting. And that's given you a little break from the questions.
Thank you. Bobby, thank you.
I have a question. Steve Clausen, Northwestern Energy. We spend a lot of time and effort on cybersecurity as it relates to the grid. What's your feeling on how we're doing on a more global standpoint across the United States in protecting ourselves from those kind of attacks?
You know, the honest answer is I don't know. Cybersecurity is enormously important for us at the Fed. We manage the transactions. One of the things we do in addition to setting monetary policy, for example, we manage wire transfer services for much of the country, as an example, and other payment services. And so we spend a lot of money and a lot of time to make sure that our computer systems, our transaction networks are protected. That's something, to the gentleman who said, what keeps you up at night? You know, you never know if you're doing enough. You literally never know. You have the experts that come in and say, yep, we've tested your systems, you're best in class, but it just takes one bad actor from another country or even our own country to find a way in that could be really, really damaging. So I just don't know if we're all doing enough. We feel at the Fed that we're always on alert. We always feel like we should be doing more. We're always trying to up our game and improve our technology so that we are staying ahead of the bad guys because they're not resting. So I don't know, specifically for the grid, if we're doing enough. Up here in the front, the lady has a question.
Yeah, my name's Jenny Negrin. I'm with Wells Fargo. I wanted to know your opinions on how you think the student loan volume will affect future generations' ability to borrow and how that will affect the economy.
So just so everyone heard, she asked about student loans and how the big volumes of student loans, how that's going to affect future generations and what it's going to mean for the economy. So the student loan numbers in aggregate are huge. If you dig beneath the surface, the really bad cases are the folks who take out a lot of student debt but then don't graduate, because then they got this huge obligation that they're saddled with and they didn't get the benefit of getting a degree, which could potentially lead to a higher paying job. So those are the terrible outcomes. Most people, if you look at the median, I don't remember the number, but the median student has a much more manageable level. I mean, you'll read in the paper somebody will have $100,000 of debt or $200,000 in debt. I think the median student is in the $10,000 or $20,000 of debt range. It is more manageable. But there's no question going forward, this is not a sustainable model. Going forward, education is only becoming more and more important for our society and to be productive in our society. So we have to find ways of educating more and more of our people without just increasing the costs. We have to find scalable ways of doing that. And I think technology is playing a part and will increasingly play a part. But you're right. If somebody has a big student loan obligation, it's going to make it harder for them to buy a house, buy a car, start a family. There are a bunch of other priorities that are going to end up being pushed to the side because they have this big debt. So again, this is really a political challenge. How do we come together to make decisions around this? But we do need to do something. The answer cannot simply be more and more and more student debt. That doesn't work.
So I think we've got time for one more question.
My name is Joe
two
Coco.
more.
I'm the owning operator of Coco Enterprises in Whitefish. One of the things that I find really attractive about Montana is we have a large number of self-reliant people. And in government, there seems to be a lot of people who are willing to solve our problems for us. And we've been talking about things like education, and we've been talking about things about healthcare. And what I have found is that self-reliant people find affordable healthcare. And self-reliant people find high-quality education they can afford. Where is the tipping point where government can help and hurt with all the assistance they're bringing to the economy?
Well, I think that's a judgment call that each of us needs to make for him or herself. I don't know if everybody in the room would agree that it's just up to you to find affordable health care, and if you look really hard, you're going to find it. Most people that I meet with don't have that view. Same thing with affordable child care. Most people don't say it's so easy. If I look harder, I'll find it. What we try to do, the Minneapolis Fed, we're not the education department, we're not the child care department, but we do try to do economic research on issues that are important to our economy to then inform the public and inform other policymakers of what the data and the analysis shows so they can make the best decisions they can. But at the end of the day, this is why we have a political system, right? Our elected representatives are representing us and expressing our values, and if you value your own individual liberty and somebody else says, I really value healthcare, that's a debate to be had through our political process. It's not for me to say who's right and who's wrong.
Okay, I think we got one more in the back here.
Yeah, hi, thank you. My name is Scott Schermerhorn. I was just wondering if you could comment a little bit about the threat of the coronavirus on the U.S. economy and what steps the Fed could potentially take to address if it escalates into more of a pandemic here in the States?
Well, it's something as you would imagine, we're watching very closely with public health officials in the U.S. and around the world. And I think these things they're very hard to, at least from what I can tell, very hard to forecast how effective some of these measures are being in trying to control the spread of the virus. So it is something clearly is a downside risk for China, and if it were to come to the U.S. in scale, would be a downside risk for our economy. And if downside risks materialize, that could affect the path of monetary policy. But I'm not sure what the Federal Reserve could do in terms of trying to manage those risks. I think it's something we would have to respond to. We talk about economic shocks. So imagine if there was conflict in the Middle East and the price of oil went up by $30 or $40 a barrel. That's a shock to the U.S. economy. That might affect the stance of monetary policy to try to help the U.S. economy get through that period. Same thing with some kind of pandemic. If it really was large enough to really hit the U.S. economy, one could imagine monetary policy responding, not to the virus itself, but to try to help the U.S. economy manage its way through until the public health officials can get their arms around it. So something we're watching, but I don't think that I, for one, have a lot of expertise in forecasting where this is going to go, unfortunately.
So one final question. You've now been Fed president for 4 years. What do you wish you would have known when you started, and what have you learned in those 4 years that we should know about?
What do I wish I had known when I started? I don't know. I think people have been, I do these town halls because I get to hear a wide range of views from people in the community. So I think that I found these a very good use of my time because I learn a lot from them. Even if people disagree with me, that's fine. I'll take something away from that. So I think that that's been very positive. I don't know that necessarily came as a surprise, but it's something I'm really excited about. What was the second part of your question?
What have you learned during the process and I think you just answered it as far as the town halls and the engagement with the communities.
I think it's talking to the widest range of people. I'll give you an example. So the consensus amongst professional economists, PhD economists. The consensus was 3 or 4 years ago, we are at full employment. And it was community groups in low-income communities who were calling BS. And they were very outspoken, saying those professional economists don't know what they're talking about. People in my neighborhood don't have jobs. They were right.
Yeah.
And so, you know, it's evidence that we need to talk to as wide a range of people as we can, because you don't know where the insights are going to come from. Maybe it's going to come from the experts, but maybe it's not. Maybe it's going to come from people on the ground. And that's been really valuable to me, and I think made me more effective in my job.
Great. Well, that's a great message to end on. So, Neel, thank you for being in Montana. We appreciate you every time you're here.
Thank you very much. Thank you all very much. I really appreciate it.